If you are considering a future home purchase, you might have seen some recent headlines that potential home buyers with high credit scores are going to be penalized due to a recent FHFA change. And maybe you've seen this headline floating around that those with good credit scores will not only be penalized, but will even have to pay more for their home loans than those with a low credit score. Like one of my favorite Twitter parody accounts, John W. Rich here posted, would he be able to buy a $10.5 million property for $200,000 and someone with better credit pay the remaining $10.3 million? Worth a try, I guess. Before you go trashing your credit based on this news or inaccurate memes like this one, are people with good credit really going to be penalized? And what other things in a home buying process are impacted by the borrower's credit score other than the rate? I'll also discuss today how to potentially outsmart the majority of that fee. That's what we'll be looking at. For a little context, we are currently in one of the worst periods in U.S. history for housing affordability. On this chart from Goldman Sachs, the higher levels on the chart up here increasing affordability. So it makes sense now with elevated home prices and higher mortgage rates that we are in a historically awful time down here for affordability. It's also clear that any additional fees or any fees make this affordability issue even worse. So what are the loan level price adjustments that are being discussed? Loan level price adjustments are a way that the Federal Housing Finance Agency can incentivize or disincentivize lenders to make certain things more or less attractive in terms of the rate and price to do it. There are several things that can impact loan level price adjustments. They're pictured here: your credit score, loan to value ratio, and debt to income ratio, as well as like the property type. So there are some things within your control and some things that are out of your control. As an example, to illustrate the stark contrast, in the past few years, to address the affordability crisis, there were some loan level price adjustments already implemented for second home and investment properties. Second home and investment properties prior to this were actually pretty close to primary residence rates, but after the implementation of these adjustments, it really reduced the demand for second homes and investment properties. You can see on the left the rates for primary residence and on the right for second home investment, and all other things are equal. So the difference in the rates for these two types are pretty staggering. If you've never seen a rate stack before, this is what they look like. A rate stack shows the rate. So right here is the rate for primary residence and rate for second home. And for each rate, there's either a lender credit, lender credits are in green, or points are in red, that you would need to pay for each rate. It's clear that the difference between primary residence and investment is pretty wide. So let's just use 6% as an example. If you wanted the 6% rate on your primary residence, you would get a lender credit of 0.422. So you'd actually get $1,266 on a $300,000 home. In contrast, if you were buying it as an investment property to get 6%, you would have to pay 2.953, which on that same $300,000 home would be $8,859 you'd be paying for that 6% rate. So there's a big incentive for primary residence and a big deterrent for investment property. That's a $10,125 difference between the two. So let's look at some rate stacks for different credit scores. You can see along the bottom here, 660 credit, 700 credit, 760 credit. It's pretty evident that as you go from left to right, that the rates are all the same, but where the lender credits start is different, and it gets better as your credit improves. So lenders distribute rate stacks daily or rate sheets daily, and you can get a rate stack for a specific scenario. So as I've already spoken about, the numbers in green are credits and the numbers in red are discounts, but in this sense it's not a discount to the borrower. You're paying money to get a discount on your rate for the life of the loan. So it's points. That's what the red numbers are, points. And these are all in percentage terms, so it's really like 0.109%, 0.249%, and it goes off of the loan amount. So you can see that the person with 660 credit wouldn't get a lender credit until 6.5%. So if they wanted any of these lower rates, they'd have to pay money to get it. The person with 700 credit can start out at 6.25% without having to pay any additional money, and they have to pay less for lower rates than the person with 660 credit. And then the person with 760 credit, they don't have to pay a fee for 5.875, and they could probably even get, off-sheet pricing lower for the same cost as someone with worse credit. So does the person with better credit have access to better rates and terms? The answer is yes. Let's also be clear, I understand no one wants to pay additional or unnecessary fees. Lower credit borrowers are already paying higher rates. They have higher monthly mortgage insurance and potentially higher homeowners insurance costs. So all of their other non-housing related loans also typically carry higher interest rates. So the fees that lower credit borrowers are paying are already high. They are just becoming less high, and that is the main change. So how much more can a high credit score borrower expect to pay on a $300,000 home purchase than they would currently? It really comes out to about $40 a month. So while it's not ideal for someone with great credit, I don't think that that type of fee is going to be the deal breaker on their purchase. So now on to the recent changes from FHFA. They are an attempt to further help with that affordability crisis that I referenced earlier by incentivizing lower down payment options mostly. I think the visual aid that Mortgage News Daily put together, and that's pictured here, about the overall change this is going to have across the buyer spectrum is really helpful. So this chart is for purchases, not refinances. Along the left side are the range of credit scores in 20-point increments. It starts at 640 because really below 640 you're not going to get approved for a conventional loan. And even in this range, you're going to have trouble in the automated underwriting system unless you have a lot of money to put down or very low debt to income ratio. But typically, if you have credit in this range, you have some credit issues, late payments, things like that. Along the top row is loan to value. So this just means how much you're putting down. So this is 95% loan to value. That means you're putting 5% down, somewhere between 5 and 10%, 10 to 15%, 15 to 20%. So where they're saying people are getting penalized is for putting 20% down. So this column and this column here, and for having good credit. But that's not really, that's not really what's happening. The credits are just getting smaller in these areas. They're not getting penalized. It is still much more costly for people with bad credit, as you can see down here. So what are they incentivizing? Well, I see a lot of green, meaning no changes or no significant changes, and light green over to the left. So people putting down a lot of money. It's not really changing for them. These are people that are paying the majority in cash. But then on the right side over here, I see some other green. So this is good credit and 5% down, and the fee is really minimal. So if let's say I had 20% to put down, you don't have to put down 20%. You could put down 5%. And then after the loan closes, you can make a principal only payment and bring your loan to value down. So if you're really intent on avoiding this 0.25% different fee here for putting 20% down, that is an option. You don't get dinged or anything for doing that. And mortgage insurance, you would maybe pay it a month. If you want to try that strategy, that's an option. I'm of the opinion that everyone would benefit from increasing their credit score to the next 20-point tier from wherever they are in terms of mortgage rates and pricing. Most lenders cap out at a 760 credit score where there aren't really any benefits above a 760, but you need it likely at least a 700 score or high 680s with low debt to income to get approved in the automated underwriting system for a conventional loan. And what is the automated underwriting system? It's a non-human system that initially evaluates your entire loan application to see if there's a likelihood that you're qualified to purchase a home based on those inputted parameters. The findings are later reviewed by a human underwriter once the loan is submitted to a lender for processing. What other things are impacted by the borrower's credit score? So most relevant for our discussion is monthly mortgage insurance. And you can see here, if you're putting 5% down and have 760 credit on a $300,000 house, 5% down, your monthly mortgage insurance is 0.31%, $73.63. If you have 660 credit in that same 5% down scenario, you have to pay 1.06% on a monthly basis, $251.75. That's more than 3 times the cost because of the poor credit. This is what I mean by they're already paying more for having poor credit, is all the fees are higher. Another less well-known fact is that your homeowner's insurance premium can also be higher in most states if you have poor credit. So this is another monthly cost that would increase if you were to have a lower credit score. I don't have any examples to quantify this for you. Just know that poor credit can even increase your homeowner's insurance. And all of those costs together go toward your monthly debt to income ratio for your home qualifying. So it could actually make you disqualified if all of these costs are high, even if you could afford the house on the monthly principal and interest. I think it's pretty clear that the key takeaways here are that it's still most beneficial to maintain a high credit score, that there is really no benefit to reducing your credit score for a home purchase, as it would really increase all costs across the board, and lower credit score borrowers already pay more for all things involved in the financing. This is especially true since your credit score impacts all borrowing outside of the home loan as well, so your credit cards could increase and all of the other loans could increase if you have a lower credit score. In the future, there are also some additional loan level price adjustment fees, and they're set to be implemented August 1st, and they are in regards to your debt to income ratio. So if you've got some debt to pay off before your home purchase, that might benefit you even more now. Anything over 40% debt to income is going to have an additional fee. I hope you enjoyed and got some value out of this video. If you would like to learn more about financial topics like this, please like, subscribe, and share. I have more videos on the way. Thanks for watching. Till next time.